Hi, I'm Badu from FreeFinCal. In this video, let's talk about how much US stocks should your portfolio have, or should you have any exposure to US stocks at all in the first place. So this is a question that many people ask, especially if they see the US stock market move up higher than the Indian stock market, and this is a question that many have asked recently. So let's find out. So what you see here is the normalized movement of the Nifty 50, which is the red line, the Nifty Next 50, which is the orange line, and the S&P 500 total returns index, which is the gray line. All of them are total returns indices, which means that the dividends issued have been accounted back into the index. So this is a normalized movement of the index since November 1st, 2002. I've taken monthly returns and from that constructed this normalized return. That's why you don't see all the details. For example, the S&P had a crash somewhere here that's not seen so prominently here because I've taken monthly returns. So if I look at this, it looks like for an investor who had stuck with the Indian market since 2002, clearly they would have done much better than having some exposure in S&P 500. But then again, we can't assume that the past will be reproduced, and India in 2019 is very different from the India that was there in 2002, because in 2002 India had just recovered from a very, very difficult 90s where it was almost bankrupt, where PPF, EPF rates were 12%, and just at that in the early 2002s, the rate had gone down. The PPF rate dropped by 2 to 2.5% in a very short span of time, and that heralded this big bull run that you see before the 2008 crisis. So that India may not be present today, and it may be necessary to have some kind of US stock exposure for not for higher returns but for lowering risk. This is a common problem among investors, that they chase after gold, they chase after US stocks for returns. No, you don't do that. You do it because you want a lower risk in your portfolio, and that need not always mean better returns. Now, what was missing in the previous picture was the US INR exchange rate, and if I include the exchange rate and plot the S&P 500 in INR terms, then you will get the blue line here. Notice that there's not that much of a difference between the blue line and the gray line compared to the Indian indices. That's because the long-term exchange rate movements, although it looks very heavy, it looks like the dollar is always getting stronger with respect to the rupee, the rate at which it's going is not very high. For example, if you take the rolling every 5-year movement, 5-year gain in the USD, it's not a rolling return, but it's very similar to that. So the exchange rate, you can see the 5-year movement is something between -4% to 8%, up and down. It's like anywhere between an SB account and an FD, that kind of thing. Not much more than that. So you should not bank your all your hopes on the forex moment to get returns from the US market, because the US markets in of itself does not have much of a gain because their inflation levels are lower. Forex will add up to it, and it will become so reasonably comparable to the Indian market, but the risk in the US market is a lot more. So now here is an example portfolio. There is to all the other graphs that you see. For example, the red is still Nifty 50, the orange is still Nifty Next 50, the blue is the S&P 500 in INR, and then there's a white line here that's been added, and that white line is 80% of Nifty 50 and 20% of Nifty Next 50. There is no S&P contribution there, and that's the white line. That's a composite portfolio, and we will now be changing this composite portfolio by adding more and more of S&P 500 INR exposure. So now you can see here, now this is 60%. Now the notice, just keep your focus on the white line and the red line. The red line is Nifty 50. Notice how the red line moves up and down with respect to the so notice how the white line, which is the composite portfolio, how it moves with respect to the red line. So this is no S&P 500, 80% Nifty 50, and this is 60% Nifty 50, 20% of Nifty Next 50, and 20% of S&P INR, S&P INR. Now, something that's, before I forget, I'll say it. Having S&P exposure or anything, if you have more than one component in your portfolio, whether it is in your equity part, in your overall portfolio, whatever it is, you have to take care of debt rebalancing. You have to make sure that it stays, that S&P 500 stays 20%. For example, if the Indian market tanks and the US market moves up, then you must rebalance it without worrying about taxes and exit loads. The problem with investors is they want returns, they don't want to pay tax, they don't want exit loads. That's not going to happen. That can never happen. You must compromise with everything in life, from marriage to investing. Alright, so that is, okay, this is, again, see the white line has now come down. This is probably the lowest I've tried. 25% Nifty 50, 25% Nifty Next 50, and 50% of S&P 500 in INR. This is probably the least volatile portfolio among all the portfolios. This movement is is affected the lowest by 2008 crash, and it kind of since then it has more or less moved up very nicely. So that's what happens in a composite portfolio. The returns will come down, but the risk will typically also lower significantly. Now we can also look at rolling returns. And if you look at this, this is a very confusing graph, and I would like you to, even if you want, you can pause the video. Keep your eyes on the dotted green line. The dotted green line is 80% Nifty 50, 20% Nifty Next 50, and no S&P contribution. And now focus on the red line, which is 25% Nifty 50, 25% Nifty Next 50, and 50% of S&P 500. So from the green line, which has got no S&P 500, to the red line, which has got 50% S&P 500 exposure, the exposure gradually increases for the other lines. Don't worry about the other colored lines. Notice that when you have no S&P 500 exposure, up to about late 2013, the no S&P 500 exposure has outperformed in terms of 7-year returns. But after that, it has underperformed. It's the lowest. But if you look at the red line, which has got 50% S&P 500, up to about late 2013, that's the lowest in terms of return. But then it has moved up, shot up considerably. So clearly, the message is that having some S&P 500 over the long term will help. But you can't have 50% S&P 500. That's a little bit of an overkill for anybody. So you must decide what is an optimal 10%, 20%, 50%. I don't have a number for the optimal. I don't have a number to give you, because the time frame over which these measurements are done is extremely limited. But if you notice one thing, the biggest spread, that is the gap between minimum return and maximum return, is the most when there is no S&P 500, and there is 50% S&P 500, the red line. The volatility in the return over 7-year returns is extremely short. So in terms of risk management, having 50% of S&P 500 would help, but it could also give you low returns, and you don't know when it will happen, when it will outperform, when it will underperform, and so on. So that's the problem. So you should be clear about this. So some exposure will not hurt, and what are the investment options? So funds like Parak Parik, in which I am invested, it has got about anywhere between 25% of US, foreign stocks, not just US stocks. I don't check it. If you hold considerable amount of this fund, then I think that's all the international exposure that most people need. I mean, there's no tax, no exit load, no worry about rebalancing, and so on. But of course, this is an actively balanced fund, so actively managed fund. Therefore, there is a fund manager risk or a fund house risk which is involved. The next option is you can consider feeder funds like the US feeder funds, or you can use the Motilal Oswal Nasdaq fund. But be careful with the Nasdaq 100, because they've got non-financial companies. It's tech oriented. The concentration risk in the Nasdaq with respect to the S&P 500 is extremely high, and if it falls, it can fall big. So be careful. The concentration risk is significantly higher. You can directly invest in the S&P 500 ETFs if you can open an international broking account, but the ticket size of investment will be large, and considering the costs involved, for most retail investors, it will not be a suitable option. But some people can. Avinash Luthria has written about it. If you're interested in international diversification, Avinash Luthria, I will request Avinash to talk about this in his Bangalore meet. That will be interesting for people. So, alright. So the point is that some exposure will not hurt. How much, we don't know. You have to take a guess. 50% is too much. I think that's an overkill. Nobody will do that. 5%, 10% I think is too small. I think the minimum is 15%. I think you can go up to 20-25%. That's the kind of band which is manageable, but you have to rebalance the portfolio. If you are not using options like Parak Parik Fund, etc., you have to rebalance it. You have to make sure the risk is managed. Otherwise, you have to ignore taxes and so on and focus on the portfolio risk. Having international stock exposure is for lower risk, not for higher returns. What it means is when the local markets are facing a bad time, your portfolio will not fall as much. That's all. If you have that maturity to handle the whole thing, you can very well have international stocks in your portfolio. So that's what I wanted to say in this video. Catch you again later. Bye bye.